Hello and welcome again. This is Robert Schein, Managing Director, Partner of Blanke, Schein Wealth Management. Thank you for joining us for our Friday Insights edition, as well as our market insights and observations from yesterday. I combined two of them into one, simply because the last 24 hours in the news cycle, we've all been captivated by the passing of the Queen. And so obviously England is in the middle of a lot of happenings this past week. If we just take a week in a review right now, and how it relates to what's happening. In fact, the saying really goes, there could be decades where nothing happens. There could be weeks where decades happen. And that's exactly true what happened in England, or what England's going through at this moment. Simply because at the very beginning of the week, we had the ushering in of the new Prime Minister, Liz Truss, as well as now the passing in the last 24 hours of Queen Elizabeth II, which was over 76 years rule on the monarch, the largest in British history. And thoughts and prayers to the family. In fact, we not only lost a queen, or that the family not only lost the Queen, or England as well, but it feels like the world did for well over 15 prime ministers in England, 12 U.S. presidents, 7 popes. And she was many things and transcending many decades, and really a true testament to who Queen Elizabeth II was for all of us. So she lives in our hearts, and maybe some great inspiration for all of us as well moving forward. But that being said, the markets were moving this week, and that's sort of what my message is to our clients, and that's why our clients keep tuning in. And yes, markets are paying attention. Actually, let's start off with England and the UK. So Liz Truss, the new prime minister, is ushered in. And on October 1st, after the next 10 days right now of Queen Elizabeth's passing in the morning, that follows traditionally as a result of that, she has to specifically call Parliament in and get a handle on the rising energy prices. In fact, October 1st is when energy prices are set to rise by 3 times in England at this moment in time on that specific day. Energy, food, everything. So as you can see, while the British government has to now deal with a lot of social unrest and now political sort of transitioning. There's a lot of unknown questions over there, but the date to be paying attention to, at least what the new prime minister has to pay attention to, is the October 1st date, because that's where inflation is going to kick in significantly for for everyone in England, because energy costs are set to rise 3 times what they are year over year. It's a reset. And so what that translates into US dollars is $4,000. So really the wage conversation, or inflationary pressures from underneath, everyone's asking for more because they need more just to pay their bills, not to mention the rents, right? Wages and rents, essentially what the Federal Reserve here is trying to get a hold of, but they have to do the same over there. And it's a global phenomenon as a result of all this stimulus dollars post-COVID. Okay. So right now in the US, we saw actually yesterday morning at the Cato conference, Jerome Powell was interviewed. It was a fantastic interview. And he basically, the Federal Reserve Chairman Jerome Powell just basically said rates will be higher for longer until the job is done. That was the take on point. Markets were down big for 200 points or so, because that moves markets. That's why we're reporting on it. What I constantly tell our clients is, listen, we're going to talk about the stuff that moves markets and what markets are paying attention to. So we are, as you should be too. So that actually was a market moving event. Markets digested that after the interview and basically said, okay, there's a possibility moving forward. He didn't say anything different. He just continued with the same message as he did when he spoke at Jackson Hole. Remember, that was a 1,000-point down day. So markets pay attention to when the Federal Reserve Chairman speaks. So as soon as he was done, markets started grinding its way higher to a higher close at the end of the day yesterday, believe it or not. And we're continuing that as I filmed today on this Friday. Now, what is the market going to pay attention to, as you should, next week? It's the CPI report. Right now, it's September 13th. So next Tuesday, 8:30 Eastern time, we'll get the August 2022 read. Right now we're at 8.5%, which is unchanged from June to July. So this is potentially of positive moving forward if we get anything less than an 8 handle, right? We potentially could see inflation or CPI rolling over. And what would be in that reading right now? Well, let's look at energy. Energy is a large component here in the United States. If you look at oil has been down over the last month or so. So that one factor in the overall report itself could be a positive for the markets because of positive for Jerome Powell, because he's set basically could be like, hey, listen, we're getting ahead of inflation, or inflation expectations are now working their way negatively in the economy. Therefore, they don't have to be, again, rates higher for longer, till the job is done. So September 13th is going to be a big day next week for us in the U.S. markets, and October 1st in terms of what's happening over across the pond over here. That's exactly what markets will be paying attention to, because there's relief that needs to be happening in England. And so for everyone there. Now, wages and rents, that's what the long-term ramifications, or at least the implication that the Federal Reserve is going after. They're going to raise rates until something breaks. I've said that many times. I need everyone to understand that what's going to break? Well, they're trying to break basically this tight job and labor market. So hopefully the earnings for corporations continue to grind their way through, or manage their way through this economy while rates are rising. Now, there's going to be the have and have-nots on the corporate earnings side. Some companies are going to do better and fare well, and some companies are going to have to lay off. And that's what the Federal Reserve's betting on, that the tightness in the labor market starts to dissipate, or at least moderate. Now, what's good is we don't have to see, in the fact of the great financial crisis most recently, we only saw an uptick of 2% in the job unemployment rate. And so we don't have to go too far. So even a quarter percentage of 1%, or maybe 0.5% is meaningful as it relates to the U.S. tightening, going from a tightening to sort of a loosening market. And I think that's where we're going to be spending our time on the unemployment side, as well as the Fed will, i.e. the markets. But corporate America will do their job. They will lay off at the end of the day, simply because they have to do what's right for their shareholders and their profitability. So they're going to manage their way through this and actually come out stronger. Corporations constantly come out stronger middle of a recession and through a recession, simply because when you're running a business, you're going to trim the fat. You're going to get rid of the unnecessary and all the extra expenses and costs. And then you're going to use technology to streamline everything. So what happens is, once you make it through the other side, you become stronger, faster, and then you can start growing efficiently and using scale and technology. And therefore, that's more profitability at a quicker pace and time. That's why we're long-term believers in the marketplace itself. So another question we get all the time is, can stocks go up with an elevated or an increased CPI? Well, our friends at First Trust have provided this research that we're going to show you in just a second that says the answer is yes. Okay. And that last 50 years, according to this research report, according to Bloomberg, is only 5 years, actual calendar years where the S&P 500 did not have a positive rate of return out of 50 years of data. So going back last 50 years. And the average on the CPI was a 3.9%. So we want a positive CPI. Okay. Right now we're at 8.5% inflation rate. We need to get the Fed's target's 2%. They actually reiterated that yesterday. They want a 2% target, but anything from 8 to around 3.5 to 2, markets will rise. Economy will take off again. And I think that'll sort of work its way through sort of the balance sheets of corporate America in a positive way, because it's still positive growth. We still need growth, but we just can't have it too hot, right? Goldilocks is sort of just sub 3%, but this is the long-term 50-year average for the U.S. on the CPI. So, around 4%, that's not bad at all. So in that period of time, the average over this last 50 years, the average on the S&P 500 was 10.87%. So 10% rate of return on average if you held it, for the last 50 plus years. So the answer is yes. Even when we have rising inflation, you want that because it's positive. It's positive growth for the economy. It's positive for corporations, positive for earnings. It's also positive for wages, right? We just don't want rents to go higher, or energy to go, and food and energy to go higher. Kitchen table economics for everyone who has to make the economy move higher so they can actually live and have some breathing room, some money in the bank, if you will. So that's what ultimately we're looking for, is the soft landing. And ultimately, all eyes are on Jerome Powell next week, or actually the CPI next week, and then the reaction of what the Federal Reserve chairman and all the presidents might say in all their subsequent speeches after that. But there's only 2 periods of time on that chart. It's going to show you, there's those 5 periods of time when the markets aren't so favorable in terms of a total return. They have actually negative returns. And that's when actually the CPI is less than 1%. So 0.9% or less. So that means that you're going into recession. So we're not in that camp right now for the US. In fact, we're 8 percentage points higher, if you will. So we're trying to get down to the 3 level, the 2 level on the CPI. And the only other danger zone is, guess what? And previously, 2 other times, you had a negative rate of return for the S&P is on those annual years is when you get into the 8s. The 8 to the 8.9% on that, historically speaking, is not a good sign. In fact, if you go higher, even in the 9s, all the way up to the 12s to the 13%, we've actually had times in history, obviously early 80s, and markets were actually higher. In fact, one of the chart is you're going to see on the chart, we have over 13% CPI in one annual year, and the S&P 500 returned over 18% that year. So again, there's the empirical evidence, that data that supports the answer is yes. When clients are asking us, hey, listen, is a positive CPI or a high CPI a good thing for stocks? Can stocks still go up? And the answer is yes, but we have to sort of manage our way through it. But corporate America is going to manage their way through it too. That's why we invest in quality companies that have been there and done this before. So that's our Friday Insights, as well as our Market Insights and Observations, 2 into 1, talking about world and global sort of issues, as well as just financial education. So we thank you for watching today, and you guys have a wonderful weekend.